What impact will last night's presidential election have on the stock market and on our ailing economy? And what will that mean for you? Tonight's special guest will answer your questions about credit, real estate, and investing. Not surprisingly, many people have questions about how the nation's real estate market or financial crisis affects them. Many are looking for ways to save money. Others want to know where to put the money they've already saved. And nearly everyone wants some reassurance that the decisions they're currently making, whether they're about credit, their homes, or investing, are the right ones. Good evening and welcome to a special call-in edition of Pennsylvania Inside Out on WPSU Radio and TV. The financial crisis and your money. I'm Patty Satalia. We've got experts on board to answer your questions, so let's meet tonight's guests. Bill Hayes is President and Chief Executive Officer of Kish Bank. Randy Woolridge is a professor of finance in Penn State Smeal College of Business and president of the Nittany Lion Fund. Nancy Van Landingham is a realtor with Remax Center Realty and a member of the Pennsylvania Association of Realtors and past president of the Center County Association of Realtors. Also with us is Dan McCurdy, a wealth advisor and portfolio manager with Abundance Wealth Counselors, which is headquartered in State College. Thank you so much for joining us. And you can join the conversation tonight by calling us at 1-800-543-8242. We did elect a new president last night, and I'm wondering, I'll begin with you, Randy. Historically, what impact does the election of a new president have on markets, and what's happened so far?
Well, historically, the first year of a presidency tends to be good. There's a lot of fiscal stimulus typically, new programs go into place. Traditionally, it's a good time in the stock market if you look at returns over the 4-year cycle of a presidency. Today was not good. Today was not good, but it's the old story about Wall Street. You buy in the rumor, sell in the news. That was all priced into the market. The market was down today. There was some economic news coming out suggesting that the recession may be closer than we thought. So it wasn't necessarily what happened last night, but Wall Street's always buying the rumor, and then you sell once the event occurs. Buying the rumor, selling the news. Explain what that means, because that's a phrase lots of people are hearing right now, and not everyone understands what it means. Well, a perfect example was when the government bailout was voted in by Congress. I mean, leading up to that and the discussion in Congress, you saw the stock markets move forward. However, as soon as it was passed, right away, the market was looking forward to what the new information might be, and the market fell off because, again, concerns about the recession. So the market's always forward-looking, and once something event occurs, it's history, and it's concerned about what are the implications down the road. Okay, the crisis began with a housing market collapse and ballooned into something bigger and more complicated than I think even those who are throwing solutions at it expected. So before we open up our phone lines, I'd like each of you, beginning with Dan McCurdy, to kind of sum up how your professional world has changed since the financial crisis hit.
Well, I think with the crisis, what's brought into focus for investing is, do you have a plan? It's kind of late in this crisis to come up with the plan because we're, I think, pretty far into it, and hopefully the recovery is coming. But what's your time horizon? What are your needs for the investing that you do have? Is it for college? Is it vacation, retirement? And then looking at what are your risk profile or characteristics you can deal with. Is a 30% loss in investments keeping you up at night? Maybe you shouldn't be so much into equity, have more fixed income. So really having an investment plan is critical in this kind of situation. Well, at Penn State, I run the Nittany Lion Fund, and we have...
Explain what that is.
The Nittany Lion Fund is very unique. We have about 70 investors who've put up $5 million. It's actually an student-managed, investor-owned fund. So we have real investors and real investor money, unlike most others. And it's a great learning experience for the students, just because when everything's going up, everybody feels smart and it's all easy. In a down market, a bear market, the S&P is down 30% this year. It's extremely difficult when the analysis you do, the recommendations you make are met, and the stock falls by 20%. And so it's a great education for the students. Unfortunately, it's been tough.
So how is the fund doing?
Well, we're down about 200 basis points above the S&P for the year. year, but still that means we're down about 30%. And a key part is understanding and how you communicate that with your investors and tell them what's going on and what you're doing to try to position yourself for the future.
How has this financial crisis affected your world in the business, in the banking business?
Well, we're paying attention. There are how many nightly business shows and a lot of talking heads out there proclaiming the collapse of the banking system, and there's a difference, and we're spending a lot of time communicating. We're a community bank. Most of the banks in this country, and there's 8,500 of them, are doing quite well, paying attention to the fundamentals and serving their local communities. So the nature of our business really hasn't changed, but communicating, making sure people understand that all banks are not investment banks, all banks are not engaged in subprime mortgage-backed securities, and most banks are still lending to their local customers who they know, they see every day, and like many of the banks in this country, we reflect the stability and quality of our local communities.
But the federal government would like to give you a piece of the pie, the bailout pie.
Yeah, and bailout's probably a way overused term. This is about the economy. This is about confidence in consumers and businesses to spend money, to continue to function without fear. So creating confidence, I think, is the Fed and Treasury's first priority. The banking system is like electricity. If a storm hits our local communities, we restore the power in a hurry. And because we're not too concerned over the first couple hours or so, but if it goes on too long, serious problems evolve. And the banking system is the flow of electricity. There are billions of dollars flowing through the system every minute of every day. And if confidence erodes, then we have a problem.
But have lending standards tightened? Have they gotten harder in these last few months?
Well, I've been doing this for almost 30 years now, and we go through economic contractions and expansions. This is going to be a serious economic contraction. There's little doubt about that. So we'll pay attention to credit quality. But as a community bank, we always do that. We know our borrowers. We understand the financial nature of their business. And so paying attention in this kind of environment to credit quality is going to be a natural outgrowth of a contraction.
Nancy Van Landingham, what's the impact for you in the real estate business?
Well, I would wager to say that we've had less of an impact in central Pennsylvania from this economic crisis than many areas of the country have, and that's a good thing. It is a little harder to get loans if you're not a qualified individual, and I would argue that that's also a good thing. We shouldn't have been lending money to people that had lousy credit and no down payments, so we're not going to be doing that anymore. Now, good thing is that most central Pennsylvania banks didn't do that at all. So it's the national banks that maybe did that a little bit more, and there are people that have loans in Center County and throughout central Pennsylvania with national banks. But,
and in fact, if you looked at the national scene, there are some states, Nevada, for example, where there are 48% of homeowners, and homeowner, I use the term loosely, who are underwater, which means they owe more on their mortgage than their house is currently valued at. About what percentage of those underwater mortgages are there in Pennsylvania? Maybe the two of you could.
Yeah, very few. Because we didn't have those 100% loans. We didn't have those interest-only loans. There are a lot of those on the West Coast where they were lend you 103% of the value of your house and then only charge you the interest. And so after 5 years you've been paying that back, what do you owe? You owe what your house was worth 5 years ago. If it's worth less, oh well, you're in a bad position. We haven't really done that in Pennsylvania.
Okay, I want to ask one more question of Dan and then take our first phone call. You said a moment ago that we're pretty far through this financial crisis, and so for some historical perspective, there have been something like 30 bear markets since the 1900s. Most have resulted in about a 27% decline, average decline, and have lasted about 363 days. If we all can agree that this started about October of 2007, we should be seeing the light at the end of the tunnel. And do you two think we are?
Yeah, I mean, that's the time frames vary a great deal, but yes, so we're looking at, we've been in it for a year. There's been a lot of actions to help. Oil's come down, and that was a headwind. The credit crisis, they've got I'll call it the TARP or the bailout plan. That's starting to loosen up money. So we're starting to see our credit markets, when we're looking at the bond market, that's better. And now you're also seeing some of the larger people who still held mortgages looking to go back and renegotiate and kind of help people out get back and try to stabilize the real estate market. So I think you're seeing a lot of steps along the way which will lead to that. And then one thing that I learned from Dr. Woolridge when I took class from him is that the markets always kind of are anticipating, and I'll let Randy kind of cover that aspect of it.
Well, I mean, one of the best leading indicators of the economy is the stock market, and it tends to jump ahead 6 to 9 months ahead of the economy. And sure enough, if you look at where the stock market swoon began, it's probably started 6 to 9 months ahead of where we went into some type of economic slowdown or recession, even though I don't think the the government has said, the Commerce Department said we're in a recession just yet. But so 6 to 9 months ahead, it signaled this summer was going to be slow and the slowing economy, and certain economic data suggests that. Now the question will be, when does the market look forward and see a turnaround in the economy? It's usually 6 to 9 months ahead of the economic turnaround. I'm
curious to know what your reaction is to the $700 billion, or depending upon how you're counting, the $1 trillion bailout. What's injecting all of that money into the economy? What are some of the consequences, maybe the unintended consequences, in your opinion?
On the upside, as Bill said, the intention is to get credit flowing so the economy grows, build credit, build the confidence of people in the economy, that sort of thing. One long-term concern I have is, with all that money around down the road, what's going to happen to the value of the dollar, what's going to happen to interest rates and inflation, that sort of thing, because there's a lot of government stimulus, both monetary and fiscal, trying to improve the economy and get things moving ahead.
Okay, I'd like to take our first call. We've got Brianna on the line. She's calling from State College. I'm sorry, Jack from Center Hall. Jack, what's your question, please?
I have a concern about how the panel is handling this debt process, or a question. In central Pennsylvania, people may not be underwater on their houses, but it's very easy credit to get things like a washer dryer on time. It's very easy credit to get a snowmobile, a $6,000 snowmobile on time. It's very easy credit to get 2 lease vehicles on time. And the younger people that I know are underwater on that level, not on what they owe on their house, but on their what I call time payments.
Good point. In fact, isn't the national average something like 17 credit cards per consumer in the U.S.?
Well, yes, I just
Do you want me to answer
Bill,
that?
yes.
No, good. Consumer debt is clearly a problem, and we've got leverage across the economy. It's not just consumer debt. It's business debt. It's debt within the financial system, and that is unwinding. It's unwinding, beginning with real estate lending and the access to that kind of credit. What Jack is referring to, and Jack, it's an excellent question. We have, in this environment, seen debt contraction begin when the value of a company's stock begins to decline rapidly because of its exposure to consumer debt and delinquency ratios. Then I think you'll see changed behaviors on the part of those companies. The problem is that many retail businesses in this country are actually in the lending business. They may be selling furniture, they may be selling snowmobiles, but where they make their profit is on finance charge. That profit disappears in a hurry whenever there's the loss of principal when the loan isn't repaid.
How concerned are you about Jack's question?
Well, we alluded to this, that the savings rates are very low. So a lot of, when I'm going out to employee meetings for retirement plans, one of the things I stress is, I show a graph that shows historically, lately, the U.S. consumer is saving about 1% or 0. So they're not saving for the future. They're leveraged up on all those cards that you talked about. And now, You know, in a recession, some people are losing jobs and things are, yeah, it's a snowball effect, but they didn't plan ahead and do the saving ahead of time.
Well, I'm wondering what your top tips are for sort of surviving in today's financial market. And I'll begin with you, Dan McCurdy.
Well, again, it comes down to having a plan. So you need to say, do I have enough money saved up? You know, typically you hear the 6-month is a time frame that people say have cash or very liquid assets saved up. And then secondly, look at what your budget is. That's a big thing that people kind of never get to, is a budget. And then lastly, what are some of your fixed costs and your variable costs? What can you do for the variable costs to bring those down? A little belt tightening. So that's the kind of things that we talk about with clients, that if we think that they're spending a little bit more or not saving enough, those are kind of areas we go through.
I want to ask you that same question in just a moment, but first, this is a special presentation of Pennsylvania Inside Out on WPSU Radio and TV, The Financial Crisis and Your Money. I'm Patty Satalia. Our guests are the President and CEO of Kish Bank, Bill Hayes, Penn State Professor of Finance, Randy Woolridge, the past President of the Centre County Association of Realtors, Nancy Van Landingham, and Dan McCurdy, Portfolio Manager with Abundance Wealth Counselors. So how would you answer that? What's your top advice for surviving in this crazy market?
Well, from my advice from the investment perspective, if you look at studies of individuals and their investing behavior, the #1 mistake people make when they invest is they freeze up during downturns. During bear markets, they do nothing. And in particular, they don't buy. And you look at the data in terms of inflows and outflows of equity mutual funds, you look at individual investor buying behavior, they don't buy. And in fact, if you have money to invest, this is when things are cheaper now. It doesn't mean you go in one day and put it all in the market, but as it turns out, stocks are much cheaper than they were a year ago. And you know, the problem is people tend to be buying up here, not down here. And so, you know, my recommendation, if you have money to invest, dollar cost average in or something, but this is the time to buy. And in fact, because, you know, and that's the biggest mistake individuals make, is they're buying at the top, they're not buying at the bottom.
Everyone's trying to time the market, and people aren't quite sure, have we reached rock bottom?
Well, it's impossible to time the market. I don't think I don't know anybody who really can. But again, that's why I say, you know, this is the time not to freeze up, as Dan talks about in terms of your investing plan. But it's certainly, things are cheaper now, and so if you have money to invest, this is when you should be putting money into the market, not trying to time the bottom, but certainly getting investing, because you're getting much better prices than you were a year ago.
Certainly one thing that's cheaper are houses right now, Nancy.
I was going to say, it's also a good time. It's a good time to buy a house if, and a certain number of ifs. You know, if you have a good credit score, if you have cash to put down, it's a particularly good time. There's an awful lot of investors taking advantage of the same thing that Randy mentioned. Stocks are a little bit less, well, so are houses, so are investment properties. So if you have, if those set of circumstances are for you, you know, it's a very good time to be buying.
How important is a good credit score, and what today is considered a good credit score for getting a mortgage?
Well, mortgage lending standards have risen dramatically as we have seen Fannie Mae and Freddie Mac go through some of the changes and the impact on their balance sheet from Alt-A and subprime mortgages. Credit scores for qualifying for the very best rates have increased. You can still get access to mortgage. Mortgage money is available, and I want to just respond to the one question you asked there about what are we reminded of in times like this, and that is that risk is real. Risk exists out there. It's been a long time since we've been through a serious economic contraction, and during those times people are rewarded for diversification, for maintaining an exposure to risk that's acceptable to them. In this environment, the Fed and Treasury have many, many tools, and they are putting them to work. We have seen the nature and duration of economic contractions actually decline as the Fed has implemented many of the tools that it has available. They recognize this as a very serious economic slowdown early on, and I think that's why we're seeing the extent of the response by regulators at the level that it is.
Now, you mentioned risk, and I think a lot of people, we've heard in the news recently about school districts that have lost their investments because they didn't fully understand the investment vehicle they had invested in. And I'm wondering, Dan McCurdy, what advice you would give for schools and other large institutions in terms of really knowing what it is you're investing in.
Right. Well, that's, I mean, what we call that in investing is the due diligence process. And so that means, you know, when you get that mutual fund that your cousin recommended, that you look at the prospectus and read it. What's the objective of the fund? Things like that. When you go to invest in a stock that somebody gave you the tip on, do you do a balance sheet check? Do you look at the income? Do you look at the management? Are you happy with all those things? You know, have you gone back and looked at the last annual meeting and what was discussed? Things like that. So doing more than just the cursory looking on the web for 5 minutes and then doing your online account and investing, but actually digging down deeper. So it's a thorough due diligence process.
Our telephone number is 1-800-543-8242. If you have a question for one of our guests, we hope you'll give us a phone call. In the meantime, the old rules, despite the situation we're in right now, the old rules do apply: diversify, diversify, diversify. But I'm wondering, in today's environment, what would a well-diversified portfolio look like, Randy Woolridge?
Well, I mean, I think part of the problem, this started out, you know, it goes back to the economy wasn't bad a year ago. And then we had this credit problem, and everybody thought that a lot of banks started announcing write-offs, and as it turns out, it wasn't one time. It was a second time and a third time. So it's become much deeper. And initially, it's real estate. Now it's consumer debt. And you know, diversification is key, but trying to find sectors which aren't impacted is very difficult to do. And that's why, you know, this is a systematic risk. In other words, it's gone market-wide. And it's very tough to hide from this type of risk. Certainly, if you were a year ago, if you saw this coming and put your money in cash, that was a great move. But as it turns out, that's why asset allocation is very important in terms of putting your money in different asset classes, because avoiding a systematic risk like this is virtually impossible to do unless you got your money out of the markets totally. But even then, I mean, you find money market funds getting hit. You see, so it's clearly a systematic risk that's spread broadly in the marketplace.
Speaking of broadly, people wonder what happened, why a housing crisis that started in the U.S. Spilled over worldwide.
Well, I think it became a credit crisis. In other words, initially it was subprime mortgages, then it kind of expanded. Eventually, when Lehman Brothers went under, Bear Stearns, it was where the markets froze up and they weren't willing to lend, and because they were afraid they weren't going to get paid back. So it became much broader than when it started, which was simply in the mortgage area.
Yeah, and another issue with the worldwide spread is the investment banks that were selling these collateralized debt obligations, they'd take all the mortgages, put them in a big tub, and then sell it to somebody. Well, they started selling them overseas. So that's kind of the way that you see that the issue got spread around the world. And they were being told by the credit rating agencies that these were pretty risk-free. These were A-rated. And now we're seeing that maybe, in fact, well, obviously they weren't.
They were not. Our telephone number is 1-800-543-8242. We go to Megan, who's calling us from Bellefonte. Megan, you're on the air.
Hi. I'm a recent grad, and I'm wondering how this economic crisis is going to affect people just out of college in terms of student loans, the interest rates, and the ability to get loans in the future.
We'll start with Bill Hayes, the banker, and then maybe go to Randy Woolridge.
Yeah, when we talk about I want to be very clear about some of the terms we're using here. We talk about most of the banks in this country. We're talking about regulated financial institutions. They make loans. It's what we do for a living. And we get visited on a very regular basis by federal examiners, either from the FDIC or the Federal Reserve or the Comptroller of the Currency. And attention to credit quality really doesn't change as a result of the economic environment that we find ourselves in for the majority of banks. You can get a loan.
A student loan as easily as you could?
Student loans, we are having discussions right now with some of our institutions in central Pennsylvania where concern by parents regarding access to credit is an issue, and they want to make sure that conduit remains open. It's really a re-emphasis of what we have traditionally known as community banking. There is a role that is performed by financial institutions that are returning local deposits to local borrowers. It's a fundamental exercise of what we do. So
you're saying if a student came
Megan, if you're looking for a loan, you can probably go to see your local financial institution or the college or university where you're attending. They are paying attention as well.
Her question brings me to one that I got via email earlier today, and that was, why has the balance of financial power shifted to Wall Street and away from local banking institutions? Where's the incentive to save locally, and does any of this make sense to you?
Well, I want to be clear that we have a banking system in this country that's very interrelated. The financial center of the banking system at 9/11 and very recently is certainly located in Wall Street. Now, we have migrated away from that. After 9/11, the fabric of the financial system held together. Everyone predicted its collapse, but this is a national system, and the predictions of collapse didn't come true, even though all communications, all of the infrastructure that connected the banking system was literally destroyed for a period of a month or two.
And you continued to function.
And everything continued to function. And we will get through this economic contraction as well.
Okay, so don't cancel your plans to go to school, because it sounds like you'll still get a loan. We go now to Jake from Mill Creek. Go ahead, please, Jake.
Hi. I had a money market with a very large national bank, which I feared was in trouble, so I cashed it in. And the local banker has suggested that because CD rates are terrible, that I invest that amount that I got from the money market into what he calls a guaranteed annuity. It's not FDIC backed, however, but he says it's backed by an insurance company. Insurance companies are in trouble too, so I'm wondering about the safety of that.
Dan McCurdy?
Well, I mean, I think it's hard to answer that without knowing your time frame that you need the money, the amount of money, and then, when you're looking at annuities, you're looking at what the sales charge is and other things like that. I'm not going to say to not do that. I would say to look at alternatives, which would be to invest in a broadly diversified portfolio. But again, if you need the money to live on now, you might want to be looking at how much you're going to put in cash, how much you're going to put into fixed income, and then into the equity markets. So I think you need to look at different components and having different buckets of money, especially if you're retired or if you're going to buy a house or a car. So cash needs need to be assessed, risk needs to be assessed, and then you can make a better informed decision.
Do you have anything to add to that?
I think I go back to Dan's previous comment about doing your due diligence before you invest in something like that, making sure, understanding that the structure of the product they're buying, the sales charge and that sort of thing, before you would just make a jump into that. Yes, because obviously what the insurance industry has guaranteed and how it's been rated by the rating agencies is under serious question these days.
Okay, we go to Michael in State College. Go ahead, please, Michael.
Yes, I had a couple questions, some things that I've heard in the past, not in the past, but just earlier on the show. And I used to own a mortgage company, and I just have to disagree with some of the things that I've heard, especially, number one, on exactly why the housing market has fell apart, especially on the subject of subprime loans. From what I understand, there's a lot of things going on with Lehman Brothers and some of the investment companies talking about credit swaps and insuring huge companies like Lehman Brothers, number one, where they'd take out $1 billion policy, pay a $20,000 premium a month, and is insurance that the company would not fold, but when the company goes to fold, obviously there was a huge amount of money that was being paid off on these companies, and it was done by more than just one person. It was a bunch of people.
Okay. Do you have a question? Do you want to follow
Yeah,
up with there?
I kind of want some. Can you talk about a credit swap? Can you talk about insuring companies, these big banks that fell? How come that is not being talked about? It's just subprime loans.
Okay, we'll get to that.
I'll briefly get to the credit swaps, and that's, from my knowledge of the subject, is that those were sold as insurance to help induce people to buy these collateralized debt obligations. So what a lot of the places like Lehman Brothers would do would say, we'll insure that $10 million bucket of mortgages, and you'll pay us a monthly premium. And what is less well understood is that was not regulated insurance. So these things were completely unregulated. There did not have to be the assets backing up what we'll call insurance, but it wasn't insurance. So that's at the heart of what was bringing down places like Lehman. Was the credit default swaps were out there when they were people came to them and said, hey, where's our insurance? Well, the money quickly ran out. So it wasn't insurance in the sense of there's an insurance agency checking up on making sure that there's assets behind true insurance.
This is a special presentation of Pennsylvania Inside Out on WPSU Radio and TV, The Financial Crisis and Your Money. I'm Patty Satalia, and our guests this evening are the President and CEO of Kish Bank, Bill Hayes, Penn State Professor of Finance, Randy Woolridge, past President of the Centre County Association of Realtors, Nancy Van Landingham, and Dan McCurdy, Portfolio Manager with Abundance Wealth Counselors. Our guests are answering your questions tonight, and you can join the program by calling us at 1-800-543-8242, and we go to the phone lines now. And Indu, who's calling us from State College. Go ahead, please.
Hello. I have a question. What are the safer investments? Are they money market, CDs, treasury bonds, or some other investments? I'm an elderly person.
What are the safest investments? I think she said CDs, bonds for an elderly person.
Well, the safest investment is treasury bonds. But one of the issues you're going to get to with that is a couple of weeks ago, actually buying, I think it was 3-month treasury bonds, were yielding negative. So you were in essence paying the government to protect your principal. So which has only happened one other time. So, these are very unusual times we're living in. I think what you have to look at is how you're going to break it up. If you're going to do a CD, look at how those are insured and that you're not exceeding any limits. Looking at also, again, being a financial advisor, what are your cash flow needs? Don't go locking up money you're going to need in a 2-year CD because you're chasing yield, things like that. So, treasury bonds are the easy answer, but I think you need to look and say CDs are insured, your money market will be backed up. If you've already had it in there, I think it was as of the 18th when they went back and said money markets are backed up. So,
Bill Hayes?
The Economic Stabilization Act of 2008 raised FDI insurance to $250,000 per depositor, and we need to bear in mind that that no depositor has ever lost a dime in an FDIC insured account.
What kind of interest are you giving these days?
Well, I think interest rates range. There are always lots of CD specials and savings account specials. But I think what is an important reminder in this environment is that you can pursue the highest return, but that always comes with a degree of risk. Make sure that the principal amount of your savings or your investment is not at risk when you're making decisions that involve what's the rate of return. Because that's the most important function.
This increase that the FDIC just made on consumer deposits, is this a permanent fix or is this temporary?
It goes through December 31st of 2009. And they also have, probably in recognition that a lot of small businesses in this country need to function with more than $250,000 in available operating cash. So they've really put unlimited FDIC insurance on non-interest-bearing checking accounts in FDIC insured institutions as well. So that's important for everyone to remember.
I'm going to go to another phone call in just a minute, but overall, Nancy Van Landingham, how does owning a home rate as an investment?
Well, I think it's a terrific investment. Most people that are in their homes, that's their biggest investment that they have. It's more than they have in their stock portfolio or anything else. So it's a wonderful time to own a home. It's a good time to buy a home if you have the circumstances I talked about before. So yeah, I think that your home is a great treasure to you, and people have to think of that as an investment as well.
So for people buying a home, it may be a good time, but a lot of people buying a home first have to sell a home.
Well, the interest rates are low. Really, the interest rates are still very low for buying a home. So if you have the cash to be able to do it, yes, it's a great time to buy a house. You mentioned about selling one and then buying another, and that's a perennial problem. It's probably more important than ever when you're selling a home to price it correctly, instead of at a level that you might dream of, at a more realistic level. And that's where your local realtor can help you.
Okay, we go now to Greg, who's calling us from State College. Go ahead, please, Greg.
Hi, Patty. Thank you for taking my call. It's a question for Nancy, but congratulations to Nancy Van Landingham and to her successor, Jay Whetstone, for their very informative newsletters that come out and talk about the real estate market in State College. One of the things I've observed in our neighborhood is that while prices haven't softened very much, that there's, in fact, a little bit longer time on the market before houses actually move. And I wonder how Nancy would translate that in terms of what its economic impact is for folks that are looking to sell houses.
Well, it's true. We are seeing a little bit longer marketing time. It varies greatly by neighborhood and by county that you're in. Right now, State College, the average marketing time in State College, Greg, is 75 days. So whether you think that that's good or bad, it's just a little bit more time that a house sits on the market, and people get to see it before they decide, yes, I'm going to buy that house versus another house. I don't think a longer marketing time is necessarily a negative. We're still seeing in State College and in Center County, we're still seeing prices stay high, and in fact, the average house sold for more in 2008 than it did in 2007 in Center County. So if it takes a little bit longer to sell, oh well.
You had something to add earlier.
Well, it's important. I think it's important to remember that we've had a very stable environment here in Central Pennsylvania.
That's why they call it Happy Valley.
And although we didn't see the 40% run-up in real estate values, we haven't seen that collapse either. Really, the people who have been hurt are the ones that kind of pyramided their real estate investments. They thought, geez, I bought that last condo, you know, on the shore in Florida, and it's already up by 20%, and it hasn't been built yet. You know, that house of cards has come down. But as Nancy just indicated, values in Center County continue to rise, and we continue to see that investment be a very stable one for a lot of local people.
Before I take this next phone call, I'd like you to weigh in on overall what you think owning a home is in terms of an investment. Anything different from what Nancy Van Landingham had to say?
No, I think that's actually, in a way, it's an asset allocation decision you make, where part of your wealth is tied up in your home. Of course, you also get to live there, that sort of thing. Historically, homes have increased in value. One of the unique things about the problem we had, you know, the financial crisis and the mortgage crisis, was the assumption was always that your housing prices would go up. And that's been true in this market, but it hasn't been true in California and Florida, Nevada, Colorado, which is where this problem has been centered. And the whole presumption was housing prices will always go up. That doesn't happen everywhere. Now, as these folks said, certainly we didn't see the big run-up, but we didn't see the big fall-off either.
Do you want to add to that, Dan?
I would just add to that, you know, with not in this area, but with the prices appreciating so much, you had a lot of people other places stretching to try to get a bigger house because that means they're going to make more money. So that's really one of the things that you would be fearful of, is people kind of over-budgeted their housing allocation.
Okay, we're going to the phone line again. Our telephone number is 1-800-543-8242, and Tom from Waterford is on the line. Go ahead, please, Tom.
Yes, very, very great show, and pretty mind meld there. I had one question with the bank owner or the head of the bank, and that was that, you stated that the federal government, with all their bags of tricks, was really on top of the bell curve on this financial meltdown. I kind of beg to differ with you as a business owner that they were caught with their pants down. It was nothing but a major panic. And that's what kind of throws me in certain situations. You're a leader of a fiscally responsible institution, and I just disagree with what you said.
Well, and you're certainly entitled to disagree with me. The Federal Reserve has always been the lender of last resort. This is not a new phenomenon we're seeing. In times of economic crisis, the Fed and Treasury step in. I'm not saying that they were prepared for this or that they understood the scope of this. We heard Alan Greenspan say that in front of a congressional hearing that the scope of this crisis shocked him, took him by surprise, and so I don't think if you heard me say that they were prepared and saw this coming, I simply believe that they are implementing a lot of tools that they're at their disposal that we haven't seen them use before, and that probably underscores the depth of what they perceive as the implications of this crisis.
All right, thank you for your call. I go to an email question that I received earlier today. Having reached the age of over 70 and a half, I'm faced with a required withdrawal of my 401 account. Since the stock market went down, this will mean I'm pulling money out of my account at the worst time. Is there a way I can change this, Dan McCurdy?
Well, no, there's not. It's a minimum required distribution, or MRD. But what you could do is look at a couple of things. One is, could you take it out of the fixed income? If you've got it allocated to some cash, some fixed income, some equity, take it out of the fixed income, because you're probably, if you haven't been doing a lot with the account at this point, your fixed income has probably remained more stable. Your equity's gone down by the roughly 30%. So if you had a plan, your allocation would have been off, or your mix. So I would say do that. Then if you have to take it from equity, I would say go ahead and take it from things that have held up the best. So go through your stocks or the mutual funds and which ones have done the best. That's how I would approach that. Anything to add, Randy Woolridge?
No, I agree.
Okay. Eleanor from State College, you're on the air. Go ahead, please.
Hi, Nancy. I wanted to commend Nancy for her excellent violin skills. I'm in the Nittany Valley Symphony with Nancy, and she is a superb violinist. So wanted to make sure State College knew about that. But I have a question, Nancy, about comparables. I have a house down the street from me that's been on the market for about, I don't know, since May. So what is that, 6 months, 6 or 7 months? And I wonder what that does to the value of my own home price if there can't be a house sold down the street. Does that make my housing price go down, or what do you think?
Well, I know it's probably tempting to think that, but the house that's down the road from you may not be priced right, or it may just not be the same kind of house that you have. Unless you're in a Levittown type development where every house is exactly the same and they have the same number of bedrooms and bathrooms and the same color paint and everything else, you really can't compare why one house hasn't sold to the other. There could be a whole lot of reasons. I mean, the price could be, it could be unrealistically high price. It could be a house that has some kind of a floor plan that doesn't appeal to a wide variety of users. It could be a house with not as many updates as your house, something like that. So without seeing the particular house, I can't tell you why one house specifically takes a longer time to sell than yours. But in today's market, one of the things that if you want to put your house on the market and sell it, a lot of people are doing is employing stagers, home stagers, to come in and look at your house and rearrange the furniture and look at your house from a position of a buyer rather than a seller and see what they would recommend.
Bill Hayes, anything to add to that?
Well, no, I think the most important thing to do is start with realistic expectations. One of the challenges in an environment where the economy is slowing is to have patience.
But if there are lots of houses for sale on a street, that certainly does, that is an indication that the value of the homes is going down.
Well, you'd have to look at a number of aspects. Have you paid attention to detailing? Have you realistic expectations about price. I think was probably a better question for Nancy.
Let me say one more thing.
Sure.
Is that the average home in State College in 2008 sold for 97% of its list price. Now that's 97% of its latest list price. It may have started a little unrealistically high and then had to come down several times, but still, I think that's a very good statistic.
I want to talk a little bit about to get maybe some historical perspective again. Lots of people are still maybe stinging a little bit from what happened in 1987, and I'd like you, the two of you, if you would, Randy Woolridge and Dan McCurdy, to talk about that and what lessons learned, and perhaps a little bit about how long the recovery took there.
Well, I recently completed a project on financial crises in the United States where I went back over the last 50 years, and I found there was 4 common elements of those. And you see that in this crisis as well. Number one is you tend to have a bubble in an asset class. So you have prices, whether it's currencies, commodities, real estate, stocks, that sort of thing. Number two, you tend to have easy financing, whether in this case low interest rates, maybe specialized financing. Number three, usually there's some type of government bailout, so the government has to step in and help out. And number four, it's going to happen again in 5 or 10 years. So that's just the way it happens. Yeah. So whether it was long, it was the dot-com bubble. Before that was long-term capital. Before that was the Asian financial crisis. Then you had to go back to the S&L crisis, the market crash of '87. The bottom line is Wall Street is a boom and bust. It just this time the bust is much higher. The cost is much higher. And it's going to take longer to dig out, I believe.
So what's your advice, again, and I've asked this before, but for surviving and thriving, knowing that every 10 years or so these kinds of things hit?
Well, you have to take the emotions out of it. That's one of the things that happen. Individuals have emotions, and that's why you look at studies of individuals. They're buying at the highs, they're selling at the lows. You have to take the emotions out of it. And as Dan says, you have to have a plan about how to deal with this, because the bottom line is, like I say, it's going to happen again in every 5 or 10 years. And so you have to plan in terms of your financial well-being, understanding that the market has a big emotional point, emotional content, and being diverse.
And that's, I've been talking to a lot of clients about this, and, it does get emotional. It kind of, what we'll call is overshoot. That, there's no reason the market's going down 500 points in a day. And what you also see on the good side is...
There's no good reason.
Right,
it's just emotions that people are pulling out.
Right, but at the end of that, when the things improve, you typically see a very rapid run-up. And that's where you don't want to be missing it and try to do the market timing. So what you're really trying to do is dollar cost average, as Randy said, stay in the market, and really, at the end of the day, when that whatever crisis it is over, you'll often see a very rapid appreciation. And so that's how we counsel people.
This is a special presentation of Pennsylvania Inside Out on WPSU Radio and TV, The Financial Crisis and Your Money. I'm Patty Satalia, and our guests this evening are the President and CEO of Kish Bank, Bill Hayes, Penn State Professor of Finance, Randy Woolridge, past President of the Centre County Association of Realtors, Nancy Van Landingham, and Dan McCurdy, a Portfolio Manager with Abundance Wealth Counselors. We go now to a phone call. We've got Sharon on the line from Hollidaysburg. Sharon, go ahead, please.
Yes, I, like so many other people, took a beating in the market in my IRA. I'm 59 years old, and I'm being advised by my financial advisor to go into veritable annuities, but I'm not really hearing positive things about it. Is there anything you could tell me about that, what your feelings are on those?
Randy, Dan, you want to start with that?
Well, as far as variable annuity, I would say that I would recommend you look at how big your IRA is and what are they counseling you as far as putting all your money into the annuity or a portion of it. I think there can be instances with someone who has been burned that you're gun shy, and that might give you more comfort. And a lot of times I don't think people have sat down and said, what's my comfort level? If you know that there's an annuity there that's going to provide some income in the future, you might be able to have a little bit more ease. But again, I think there's a cost with these variable annuities. There's a couple of layers of cost. Typically, you've got the fund management and then the insurance component of it. And so I would say that you also need to look at really having a broadly diversified, well thought out portfolio, and that's what your financial advisor should be able to provide with you.
What might she also consider, if not just an annuity?
Well, really the best way is a broadly diversified portfolio. I mean, I think when you start to look at products, and we've seen various products been introduced to us to pass on to clients, and some of these had principal protection, you know, those might have been good at the time, but a lot of them ended being backed up by investment banks. So I don't know where those are now. We passed on those. So a lot of times people get a little bit too fancy and kind of look for a little bit of, we talked about the risk and reward. You know, really understand if you're going to be going out and trying to get more reward, there's either going to be risk associated with it or there's going to be a cost associated with it.
Anything to add, Randy Woolridge?
No, just make sure you understand the product and who's behind it and what type of protection you're paying for. Because so many of these have imploded because they were guaranteed or rated one way or another, and those who are the counterparties or behind it weren't financially viable.
And the information you say investors should seek, how readily available is it? Where do you go to find it?
Oh, it has to be, in order to sell the product, you have to be provided the information. You have to be able to ask the right questions.
Okay. And that really is the key. So what are the questions that you advise people to go into their financial manager with? What kinds of questions?
Well, one of the easiest ones to go into, and I think is very important, is how are you compensated? So are you being paid to sell me this product, or are you merely going to be providing me advice and then bill off, you know, like we bill off assets managed. So if we were to sell somebody a mutual fund, we're not compensated for that. And then secondly is ask where all the fees are and break that all out. So really finding out, know the product, and that again is a due diligence process.
Okay. We go to Betty, who's calling us from Williamsport. Go ahead, please, Betty.
Hello?
Hi. Do you have a question?
Hi, is this Patty?
It is.
I don't know whether you have anyone old enough on your panel tonight to answer my question, because back in 1980, I had to invest payouts from life insurance. My husband had died recently, and I took it to a local bank over in the corner, and I was offered 10% interest rate. They would pay me. How did banks in those days get away with paying so much for money?
Phil Hayes?
Betty, I can tell you I remember. It's not a story someone told me, but I was in the banking business. That was at the height of interest rates and inflation. If you were a business borrower, you might be paying 20% interest. If you were looking for a mortgage, you were looking for 14%, or looking to pay 14% interest. Fortunately, we rang inflation out of the economy as a result of those high interest rates, and if you were smart enough to lock in that 10% for a long period of time, you did great. But banks really don't set the interest rates. You know, it's a function of market dynamics and disciplines. Within certain ranges, you can see some variations, but it is market forces. The Fed manages the money supply and federal open market activities by managing short-term interest rates, but the rest is a function of the marketplace. So that's what you saw then. And
too bad we're
not
seeing it now.
Today, fortunately for everybody, interest rates are much lower.
Well, you know, to put this in historical context, you think about it, with interest rates on long-term treasuries have been in the 4 to 5% range now for 4 to 5 years. The last time that happened was the early 1960s. So, I mean, interest rates have been much higher. And so, in a historical context, what we see in terms of interest rates today is very unique over an extended period of time, and we haven't seen that for 45 or 50 years.
Okay. And in the housing market, interest rates at one point were 14, 18%, and people were still buying houses.
Okay, we started this conversation by talking about the impact of a new president on the market, and a lot of people say that one of the most important jobs that President Obama will have will be quickly naming a new Treasury Secretary. And I'm wondering, beginning with you, Dan McCurdy, any advice for him?
Well, I think with the recent travails on Wall Street, probably to go away from Wall Street at the moment and get somebody who's been in the U.S. government in that kind of realm. It would be my advice. But
Randy Woolridge?
Well, actually, I think in terms of, in a certain way, it has to be somebody who understands the problem. I think that's why the people now who are involved with are Wall Street people, because they kind of understand the problem. The fact that the plan went in place was because there were no buyers, there were no bidders, so the government had to come in and be the bidder. So the key thing, I think, is understanding the structure of these products, the complexity of the products, the lack of disclosure on a lot of these things, because there's still a lot of unwinding that has to take place. But they have to understand the banking system, understand the key is the continued flow of credit.
Is there someone that fits that bill?
I don't know. And again, it's just somebody who really understands the complexity of the situation, because it's a blending of the commercial banking system with the investment banking system.
Bill Hayes?
Credibility. The financial markets right now are in a very tenuous state, and the next Treasury Secretary has got to be someone who has the respect of all the players in the financial industry and in the marketplace.
Okay. Thank you to our guests. Bill Hayes is President and Chief Executive Officer of Kish Bank. Randy Woolridge, Professor of Finance at Penn State Smeal College of Business. Nancy Van Landingham, a realtor with RE/MAX Center Realty and member of the Pennsylvania Association of Realtors. And Dan McCurdy, a wealth advisor and portfolio manager with Abundance Wealth Counselors in State College. That's going to wrap things up for this edition of Pennsylvania Inside Out. I'm Patty Satalia. For all of us here at WPSU Radio and TV, have a good night.
A copy of the program you've just seen can be purchased through Penn State Media Sales at mediasales.psu.edu or by calling 800-770-2111.